trouble with having a lot of debt is not just that risk of bankruptcy, but there's also something called debt covenants. And these are restrictions. Restrictions placed by the lender. The lender is also known as the creditor. The creditor is concerned with getting repayment. They want repayment and then they want their interest revenue throughout the term of the loan. So the creditor can put in the debt agreement, the contract that the borrower pays, certain restrictions or covenants on the borrower. Borrower, of course, also known as the debt holder or the debtor. And some examples of these restrictions, it could be limitations. So I'm lending you $10 million, but I'm limiting you on how much future cash you can borrow. It could be restrictions on dividend payments. On how the borrowed money can be used. There can be minimum working capital requirements. So they must tell companies you must have at least this amount in current assets compared to your current liabilities. And you need to report these financial statements under GAAP so that we can see that. Maybe a maximum amount of debt to equity ratios. And minimum amount of interest coverage ratio. In other words, interest coverage or times interest earned ratio. Typically, the creditors are going to require financial statements prepared under GAAP so that this information can be measured. And if there's a violation of a debt covenant, the creditor can demand repayment. So it's risky, right? Borrowing is risky. It's costly. There's this interest cost. It can drive the company into bankruptcy. It can lead to limitations on how the money is spent and what you're doing with your assets and liabilities. So far it sounds like perhaps borrowing isn't the best thing to do. There's two ways to finance these assets. So remember, there are assets, the resources used to generate sales and income. And then the other side of that balance sheet is how are those assets financed? Some mix of liabilities, stuff from running our company, and the long-term liabilities, notes payable, bonds payable. So the total liabilities are one way of financing the assets. And of course, the other way is with the stockholders' equity. The major components of stockholders' equity: common stock, perhaps preferred stock, additional paid-in capital on common and or preferred stock. Most companies only issue common stock. Retained earnings, all of the company's income less all of its dividends. Since it first became a company, they get reinvested into that company. Accumulated other comprehensive income. We reduce stockholders' equity with any treasury stock. And this gives us our total stockholders' equity. And of course, the total liabilities plus total stockholders' equity needs to equal our assets. So when a company is looking to finance its assets, it has this choice between issuing common stock and getting cash in exchange, perhaps preferred stock as well, or taking out loans and issuing bonds. These are the major ways for companies to raise large amounts of capital. So how does a company make a decision? If we know that liabilities, notes payable, the bonds payable, they increase the company's risk, what should the company do? So let's look at some of the trade-offs between debt and equity. Financial leverage is the degree to which a company uses borrowed funds, so liabilities, or we might use the term debt. Degree to which a company uses borrowed funds, we can consider this debt, or we can consider it total liabilities. To earn a return, or in other words, to increase returns to stockholders. So there's two parties that are interested in the financial performance of a company and the financial position, the ability to repay the liabilities. The creditors, because they want to get repaid, and the stockholders, because stockholders are saying, borrow the money as long as it's going to earn a return above the interest cost, then it's going to make the stockholders' investment more valuable. So let's look at an example here. One more definition before we go through that's related to financial leverage, and that is capital structure. So while leverage refers to the use of liabilities in order the use of capital, whereas financial leverage refers to the use of liabilities to increase returns to stockholders, capital structure is simply the company's mix of liabilities and equity without any strategy whatsoever. All right, now let's look at an example of the use of debt and equity. Let's say a company wants to raise $50 million so that it can invest and run its operations. The current market interest rate on debt is 8%, and the current tax rate is 25%. Regardless of how they finance, whether the company's going to borrow and subject to this 8%, or whether it's going to issue stock, the income that it's going to be able to generate is going to be $8 million off of the $50 million. So income before interest and taxes. So we're saying that the company needs $50 million and it knows that it can earn a 16% return on assets. It knows that it can generate $8 million regardless of the financing, regardless of its capital structure. Okay, so let's look at two different scenarios here. One is if the company issues $10 million in debt, perhaps a borrowing from a bank or issuing bonds payable to the public. And then the rest of this would need to be, the rest of the 50 million would be issuing stock. So maybe they issue 40 million in shares of common stock. This is alternative one. Alternative two is if the company borrows $30 million in debt and then only needs to raise $20 million in equity. Okay, so what would this do to the company's financial statements? Regardless, income before interest and taxes is going to be $8 million. There was a 16% return on assets. And then let's look at what the rest of the financial statements, the income statement would look like. Interest expense in scenario 1 would be $10 million times 8%, or $800,000. And so for scenario 1, income before taxes is going to be $7,200,000. Okay, so small amount of debt, small amount of interest expense. If the company, then the alternative where there's $30 million in debt at an 8% interest rate, interest expense is going to be $2.4 million. So look how much lower income before taxes is going to be. Both companies are going to be subject to income tax expense, provision for taxes. We said that it's going to be 25%, so 7.2 million times 0.25 or 25% works out to be 1.8 million. Scenario 1, we have net income. This is the more equity-based financing. We have net income of 5.4 million. Scenario 2, $30 million of debt, higher interest expense. The income tax expense, 5.6 million times 25% tax rate, works out to be 1.4 million. And net income, 4.2 million. Okay, so on initial inspection, we see that net income is quite a bit higher when we use less debt, and that's because we had lower interest expense, of course. But what if we look at the company's return on equity? Return on equity, 5.4 million. Is net income divided by stockholders' equity. Let's say we issued $40 million in equity on January 1st. At the end of the year, we produced the 5.4 million. The entire year, we had $40 million in stockholders' equity outstanding. This is going to be a return of 13.5%. Now, we have lower net income in scenario 2. Alternative 2 has much more greater use of debt, which resulted in lower net income, but our denominator is significantly lower. Instead of having 40 million of debt outstanding all year, we have half of that, 20 million. So a lower net income, but a reduced denominator to a greater extent. And this would turn our return on equity in scenario 2 to be 21%. So to the extent that investors care about that return on equity, which is what investors want, is that return on equity, investors are saying, go ahead and borrow money from the banks as long as you're earning a return. That 16% return on assets, that's $8 million here, that's greater than the interest expense. Then it's going to keep increasing the equity, the return on equity. So as long as the expected return on assets is greater than the borrowing cost. Here the borrowing cost was 8%. The use of debt, right? We were earning 16% in this problem, return on assets. The borrowing cost was 8%. The use of debt will increase the return on equity. And so investors are actually happy. They want the company to borrow as long as this situation holds. So again, like we said, for the liquidity measures, we don't want the debt to be so high that we can't pay back, but even the stockholders do want that debt amount to be high in order to increase the ROE.